Joining us, Tyler Elgard is with us, investment analyst at Gradient Financial, and Hatem Dhiab, managing partner at Gerber Kawasaki Wealth Investment Management. Thank you both for being with us. So Hatem, I mean, what we thought about Netflix, right? It was the king of streamers because it got the early start. It had the biggest catalog and choices, and certainly has had a lot of hits that people became very addicted to and excited about. At this point now, is it still Netflix the leader, or which of the companies do you think may have the best chance of being the top on the throne?
Hey, Nicole, thank you for having me again. I still think it's the leader. I mean, Netflix has defined the streaming category, and I think it's continued to do that. One of my partners here at Gerber Kawasaki wrote an article last week about streaming, and he called it "Barbarians at the Gate." And he's basically just saying that the competition is real, and it's just happened over the last few years, where finally we have Disney and Amazon and Apple who really came to play and have some tremendous content. So they're really challenging Netflix. I think it's good for the whole industry to have so many players. Hollywood is thriving as a result. We're in Santa Monica. We deal with a lot of these people industry, and we've seen how well they're doing right now. But ultimately, I think Netflix is the one that's gonna keep winning.
Yeah, it's interesting because it's at 182. So where do you see this stock, Hatem?
I mean, the whole, you know, we tell this to clients all the time. The macros trump the micros. Right now, all the media stocks are down. All the tech stocks are down. So the individual stories are not really thriving. Now, yes, Netflix is decelerating its growth, so the stock has gotten hit a little bit more than most. But I think ultimately, if you like the stock earlier on, now you're trading at 15 forward PE with a company that does $7 billion in revenue a quarter. I think you love it here.
Yeah, and Tyler, I'd like to ask you the same question. I mean, as you look at the group here, we know that Netflix was the original leader, but now you're saying that, look, it's very highly competitive. Maybe some of the people who are at home and watching and all that are getting back out, and you have ad-supported streaming. That's another issue, and that this is all going to take some time to work through. Tyler, where do you see some strength?
Yeah, so I mean, similar to the other guests, we do like it here. We are a little more hesitant. We think that a lot of the risk has been priced into the stock at this point, but we're going to have to wait for some commentary for Q2. The guidance and the actual report in Q1 were not great at all. So we're still trying to wait for some inflection points in the subscriber growth here. But as far as the streaming service as a whole, you know, it's very competitive. You know, they used to be sharing content, and now they're keeping it for their own on their own platforms. So from a viewer standpoint, it's great because we've never had this many great shows and movies to watch. But from an actual provider standpoint, it's much more difficult because content spend doesn't necessarily lead to higher revenue growth. And so they have to be a little bit more selective on what they're choosing, because, you know, if you're making a show or movie for a specific demographic, it's not going to be a global hit. So they have to be much more selective on the shows that they're producing and for how much money they're going to be spending on that content.
And with them all being formidable competitors, Hatem, that's how you referred to them in the notes, and the group, the whole entertainment group has been under pressure. Are there more bargains to be had if they all really are formidable and do have some potential here? We showed some of them, Paramount and Warner Brothers Discovery, Netflix, Amazon, Apple, HBO. Would you buy them all?
I don't know. I would not buy them all. I work in Los Angeles, and I deal with a lot of these entertainment companies. A lot of them are just not well run. I think if you want a pure play streaming players, Netflix is really the best bet. Disney, very, very compelling at these prices. You know, the economy is reopening. We have the parks going to be doing really well. Also, the box office. You know, some of the newer players like Paramount and Comcast, I'm just not a big fan of them. HBO, it remains to be seen what happens with the Discovery merger and how that kind of plays out. But ultimately for us is more Disney and Netflix are the players that we really like at this point.
Disney and Netflix, understood. And what do you think, Tyler, here? as they are trying to work on subscriber growth. I mean, even Facebook saw fewer subscribers. I mean, it's not the same, but in the social world and how people are on their computers trying to do just about everything. What do you think?
Yeah, so I mean, I think the introduction of an ad-supported platform will be really, really positive for their subscriber growth. Again, it's going to take some time for that to flow through the system, and you'll definitely have people moving from premium subscribers to ad-supported subscribers. So that's going to take some time. But on the Q1 call, they were talking about 100 million password shares, or it was a little uncertain of what the 100 million count was. But even if they can convert a fraction of that to an ad-supported service, I mean, that's going to provide, even if they do 10%, that gives you 10 million new subscribers. So if they can do that and convert some of those shared passwords, I think the growth here for Netflix is looking really positive in the near and medium term.
Yeah, you make a great point where everybody was sharing their subscriptions, right? That was a very good point you made. So that being said, now going forward, as they have to, right, they're limiting that, so you can't have 10 friends trying to use your Netflix account. Hatem, your final thoughts here, because people are not in front of their screens quite as much. You do have international expansion as a possibility.
2 points, actually. I'll add to Tyler's point. I think the international growth story is underappreciated, and the ad support is up with that. So I think if you add this advertising model to a lot of countries that can't afford the $15 a month, this is going to add a tremendous amount of new subscribers who will eventually go into just a full subscriber mode eventually. So that's a really, really great thing. And we saw Ted Sandros in Cannes last week, basically being rolled out of with the red carpet, because the advertising industry understands how big this will be. But then too, summer is here, right? So we're all doing other things. The attention industry, I call it. People are spending time on TikTok, on Facebook, and other things. So we're doing other stuff. We're going out. It's a different time.
And Tyler, you said it may be a good idea to just wait and see the earnings of Netflix, right? Quickly.
I did, yeah. I mean, you're getting a good company at 17 times next year's earnings. A lot of the risk is really out of the name at this point. It was down 75% from the highs at one point, come back a little bit. But again, I just think we wait to see what the Q2 report is and what their commentary really is around this ad-supported option and subscriber growth going forward.
Understood. Nice to see you both. Tyler Ellegard, Gradient Financial. Hatem Dhiab, Gerber Kawasaki Wealth Investment Management. Thank you both.